Can you just give me just put a 1 in the chat if you see the screen. Okay, cool. Cool. All right, awesome guys. So yeah, let's get started. So after this, I'll ask you guys kind of, how the experience was with Riverside. I really like Riverside because especially it makes like providing the recording afterwards super easy and high quality. But if the experience ends up not being good, then we'll go back to Zoom. So um, cool. Ken, yeah, reload or refresh or try to rejoin. All right, let's get started, guys. So selling smart. So I tried to break this down into as simple terms as I possibly can. So I'm basically in two modes. It's either aggressive or defensive. If we're in an aggressive mode, we are increasing exposure. Right, progressive exposure is incredibly important, and it's basically how you stay in the game long term. So if we're in an aggressive mode, we're increasing exposure. We will have larger positions, and we're stepping on the gas, right? So when we're aggressive, it's an easy money environment, and on the flip side, when we're defensive, it's a hard money environment, right? It's hard to make progress so far, like this year, except for Rye, but it's hard to make progress. You want to reduce exposure, and you're kind of putting on smaller, what I call pilot positions. So the two modes that we're really in can be summed up into aggressive or defensive. I this can be breaking down further into maybe like a little middle one where you're trying to get traction versus completely defensive where you should not even be putting on pile positions and being cash. But for simplistic purposes, this is really uh, the two modes that we operate in. So how do I know when I'm aggressive versus when I'm defensive? So it all comes down to a feedback loop. So in the general market, in a strong market, your personal performance dictates everything. So how I depend if I'm aggressive or defensive depends on my personal performance. And that is a direct feedback loop of the type of market that we're in. So in a strong market, if I'm making progress, I'm going to get aggressive. In a choppy market or a weak market, if I'm not making progress, I'm going to get defensive. So, yeah, so Ken, sorry, I don't know what the issue is. I really apologize for you not being able to see. Um, feedback loop. So if you can't see anything, I'll have the recording very shortly later today, but I will keep going just because it seems like everybody else is able to see. The feedback loop is very important. You want to listen to your recent trades, right? So this year, I have been struggling to make meaningful progress. And so that, is indicating that we're not in a very strong market. Um, I wouldn't say we're in a weak market. I believe that we are in a choppy market, and I'm going to dive deeper into this in a few slides. But this is basically the feedback loop that completely determines how I'm approaching the market. Am I aggressive? Am I defensive? It all depends on, are my recent trades working? Am I making progress in my portfolio? Or no, I'm not. And if you listen to your recent trades and your recent activity in the market, that's going to basically tell you if the market's strong, choppy, or weak before looking at the market itself might even tell you, if it is or if it's not. So if we jump into the general market first, so the general market is incredibly important, right? It is the M in Can Slim. It's the last letter, but uh, it's the most important letter. And it's because nothing matters if the general market is not cooperating. 3 out of 4 stocks follow the general market direction. And this is a quote from William O'Neill. So that means 75% of stocks, if the market is strong, they're going to go up. If the market is trending down, 3 out of 4 stocks, 75%, they're going to follow the general market down. So that's why, in a bull market, it's very simple to make money. We're not just a bull market, but a strong trending market. It's easy to make money versus if you don't listen to the feedback that we discussed here, where people will stop making progress, but they won't take that as feedback and they won't switch the mode that they're in. And that is a major mistake. So if you're not listening to the feedback, you're going to be very late and you're not going to adapt quickly enough. So understanding what type of market you're in has a whole lot to do with your personal trades. So if we pull up first a strong market, right? So 2024 is what we have here. Now, the characteristics of a strong market: you have a clear trend, frequent new highs, and corrections are followed by new highs fairly quickly. So, since 75% of the stocks follow the market, when you have a strong market, it is incredibly forgiving. So this means, like, even if you have poor risk management, you can still get away with a whole lot, because you have a 75% chance that that stock is going to go higher and follow the trend of the market anyway. So you can see one of the characteristics is corrections are followed by new highs fairly quickly. I don't know if these are, exact corrections. I'm not sure, but regardless, these are nasty pullbacks within the uptrend. And even if you don't have your risk controlled here, people still get lucky because, you know, a couple of weeks later, you're back to new highs. And that's a strong trend. And so this is where, people think that they're doing, or they're more talented than they really are. And, it's, I don't want to negate, still it's hard to do extremely well in a strong market. I'm talking triple digits, so I don't want to negate, the effort that does take. But strong markets definitely forgive your mistakes a lot more. And so what what separates traders that, make it 10 plus years and invest and make money for a long time versus traders that, lose their profits or just lose money and don't make it. It really has to do with, a lot of people will enter and get involved in a strong market, and maybe they, let a stock pull back 14%, but then they get lucky and a couple weeks later it's, back above even. That's because this type of market is very forgiving. And if you bring those same habits to a choppy market or a weak market, um, you're gonna get absolutely destroyed. So if we now go to a choppy market, if we now go to a choppy market, we look at 2025, so where we're currently at now, and this year so far has been fairly choppy. And what's frustrating about choppy markets is there's a lot of good setups, and there's a lot of stocks that are, breaking out and acting normal. But regardless of all the stocks you're seeing breaking out, it's just a very tough environment and it's very confusing. And it's important to listen to that feedback loop that we mentioned to identify, if we're in a choppier market, because, you just don't want to mess up your progress. And so the characteristics of a choppy market is sideways action and no new highs. The market is less forgiving and very frustrating. And this means if your risk management is poor, you're gonna chop yourself up. And these consolidations could definitely be before a move higher. It doesn't mean, like, these choppy periods could be followed by a move higher, or they could be followed by a move lower. But the fact is that these choppy environments, it doesn't necessarily mean sell, right? Like the market's going to go down, but it definitely, you can't approach it the same way that you were approaching a strong market, because you're going to chop yourself up. And even if in 2025, like you could see that we have no clear trend here, right? It's been uh, 2 months and we have not made any, but there's no trend. There's no trend at all. We're just going sideways. And we did previously make, a high, I think last week, but um, that's it for now. And we really have to wait and see. So what happens is this is just an environment where it's not an easy dollar environment. It's hard to make progress, and so you just need to adapt. You just need to recognize if your recent trades are not getting traction, and you're getting the feedback that the market is a bit tougher. You don't want to, if you've taken a few losses here, you don't want to get frustrated and then start sizing up to make up for it and act like, the market was how it was last year, because that's how you're going to decimate your account. So this is essentially what I would consider a choppy market. And there's nothing unhealthy about it. It's just part of the cycle, right? Like, uh, the market has to move sideways and consolidate before it moves higher, or this could be distribution and then we move lower. So you really don't know, but the point is it's not an easy money environment here, and so you don't want to treat it like it is. Now, if we look at a weak market and we go to 2022, we have a clear trend, just like a strong market, except it's it's a downtrend, and I would characterize that by frequent new lows and lower highs. One thing about weak markets versus strong markets is these downtrends, they have huge price swings higher. And that's what makes it, uh, you've heard the term bull trap. That's what, there's a ton of bull traps in a bad market. And, it's not forgiving. It's full of traps. It's not forgiving. The trend is down. In 2022, we're clearly making lower highs and lower lows. And just like we discussed before, 75% of the stocks are going to follow the general market. So even if if you buy a stock, a random stock during this period, you have a 25% chance that it'll even go up. And that's on top of, other things. So the odds are heavily against you, and you need to acknowledge where you are. The frequent rips higher, they suck a lot of traders in, but the trend is still down. So there's really no room for error here, or to be long at all. So what happens with these weak markets is these little rallies kind of look like pockets of strength, and they suck everybody in. And if your risk isn't managed, you're going to get absolutely, decimated. So understanding what market we're in, strong, choppy, or weak, is is the first part of the equation here. Now, the next thing is progressive exposure and feedback. So you want to listen to the market, right? The feedback loop. Are recent buys working, and is your portfolio making progress? So if recent buys are working and my portfolio is making progress, I'm going to step on the gas. I'm going to increase exposure. I'm going to get way more aggressive. If the market, essentially, if you break it down into simple terms, when you're in a strong market like last year, it is an easy, all of the odds are in your favor and the wind is at your back. And so that's when you want to step on the gas, because you have an opportunity to make a whole lot of money, uh, pretty easily, right? Where it's not the same if you're not trending higher. So if my recent buys are working and my portfolio is making progress, I'm going to increase exposure. And so that means I'm going to get aggressive, right? If I'm making progress on my portfolio, I'm meaning like, my portfolio is up above the S&P for the year. My recent trades are getting traction and working. I'm not getting stopped out. Then that's feedback that the market is strong and making progress. And so in this scenario, I might risk 1 to 2% of my total account for a trade, right? So you generally hear that the rule is risking 1% per trade of your total account. And that's like, you know, that's a very simple way of looking at things. It all depends. Sometimes I might risk 0.5%, sometimes I might risk 2%, but it all depends on the feedback and understanding exactly where in the market we are. So just to reiterate, in 2024, if I'm up, 50% on the year, all of my recent trades are getting traction. The wind is at my back. I see a really good opportunity. I have no problem, risking more on a trade and sizing up because the odds are in my favor. Now, if you look at 2025, are recent buys working? Is your portfolio making progress? If they're not working and your portfolio is not making progress, you need to decrease exposure. And this is essentially the defensive mode. So it in 2025, like right now, I've taken a ton of losses this year, which I discussed on X, and but like I'm unfazed, right? Like it hasn't destroyed my account. I'm essentially flat and just not making progress. And this is because the recent feedback on the market and my trades not getting traction is basically telling me, okay, the market right now, the wind is not at your back. And then if you look at the market itself, right, you'll see that there's no clear trend. We're chopping back and forth, and it kind of confirms, um, it kind of confirms your opinion. And so that means that I'm mostly putting on kind of like pilot trades and trying to get traction. If my last 4 or 5 trades are getting stopped out, then I'm not gonna see a new trade and risk 2% of my portfolio because odds are I'm going to get stopped out, and I don't want to get it. I don't want to take a 2% portfolio risk. Uh, and so in this scenario, I'm generally risking a much smaller percent, 0.5% of my total account for a trade. Could even be smaller, right? You really don't want to, like, sometimes if you're too small, there's really no point to even be involved. So it's better to just not do anything. But still, you know, I call them pilot positions. I didn't come up with that. I heard it from someone else. But pilot positions, sometimes you just put on a small position, and you kind of just get feedback and see if it works. But if it doesn't, you're not harmed. But the point is you're kind of just putting on a smaller position, and the main goal is you just want to get traction. Uh, you just want to see progress being made, basically. So now if we go to the great Livermore, who we know, right, didn't manage his risk at the end. Uh, but he says that money cannot consistently be made trading every day or every week during the year. And this is incredibly important. I think Warren Buffett also had a quote saying that something about it doesn't always rain gold, but when it does, put out a bucket or something like that, insinuating basically that the market has periods where it is incredibly easy to make money and periods when it's not. And when it's not easy to make money, you want to be very reserved, and you want to focus on preserving your capital. But when the market is an easy environment, you want to also step on the gas. And something else, like holding on to your money when the market is not incredibly favorable and strong is so important because, you know, if you get chopped up and ruin your account in a hard dollar environment, even when it becomes an easy dollar environment, you're going to be, chopped up. Your confidence is going to be gone. You're going to be set back, and you're not going to take full advantage of the easy dollar environment because of that. And so it's super important to keep yourself uh, whole and keep yourself from any setbacks, so that when the easy dollar environment does come around, you have full confidence, and you're fully taking advantage of it. And so people like to say, "Oh, in a bull market, everybody makes money," and like there's truth to it, but also, not really. If you came into 2024 last year, chopping yourself up the prior months, and you put your accounts 20-30% off the highs, your confidence is shaken. Now when the market is extremely easy and the odds are in your favor, uh, you're not going to press the gas like you should, because your confidence is gone. Your account is set back. And so not only are you digging yourself out of a hole, but you don't have the confidence to act properly. And that is incredibly important in a bull market. So this, I am kind of just showing you guys the S&P for the past couple of years, and again, the environment, right? Choppy, weak, or strong. And you could see that these choppy periods that we had here, the choppy period we had here, and the choppy period we're in now. So these people don't lose a lot of money just in these weak periods. They lose a lot in these choppy periods because they're not listening to the feedback of their trades, and they're still approaching it, excuse me, like they were in the prior uptrend. And if you do not listen to the feedback in these green moments when they switch to this choppy period, it doesn't matter, like this situation here, you could see we went up, we chopped for like what, 2 months, and then we had a strong uptrend again. And so this choppy period was just a little chop within a larger uptrend, but a lot of people won't recognize when they're here, and they're still pressing the gas like they're here. And so even though the market did resume a very strong uptrend, they're giving up a lot that they made in the previous cycle. And that's, that's one of the biggest issues on why people struggle to make progress long term. So um and then if you look at this choppy period, right, like fortunately this one resolved in an uptrend. And so this was like a little very brief consolidation kind of zone before we went up. If you look at this one, right, we had a couple weeks consolidation, choppy, very choppy. You would know this if you were getting the feedback in your positions. Your positions are going to tell you what's going on and your recent trades, like before the market does. And so you need to acknowledge it, because you never know what comes back. And I'm not a perma bear at all, right? I'm very optimistic on the market, so don't take this the wrong way. But if you look at here, right, last week we made a brief new high out of the chop and then pulled back. The same thing we did in the end of 2021. We chopped kind of sideways, made a quick new high, and then that was the beginning of the bear market. And so in this situation over here, it, if you chop up and give up a lot of your profits over here, uh, you know, you're going to be fine in the end because the market's continuing upward, but you're still setting yourself back for no reason at all. Now here, if you do the same thing and you chop yourself up, if you don't, listen to the feedback, this is how you can blow up, right? Like this is how you can blow up as a trader. And so last year was a very easy market, a very easy environment. And right now we're kind of just figuring things out, right? This is either going to break out to the upside, or, we're going to see weakness and break out to the downside. But the good thing about these choppy periods is that, you're going to feel the feedback because your recent trades are going to be stopped out a lot more frequently. Um, and as long as you're listening to that and taking that into account, you're going to be fine. But if you're getting stopped out more frequently, and instead of taking that as constructive feedback, you're getting frustrated, and now you're doubling your position sizes and trying to, make up for lost ground, that's really that's what's going to screw you over. And so this is what I kind of just explained, right? These 3 periods of chop, these two both played out completely differently. And so right here, uh, you're just kind of in defensive mode. Not like this, when you're in a clear downtrend like this is really full defensive mode. But right here is when you're getting the first signals and you want to just be 100% sure. So again, before we move on, if you look at this chop over here, if you know got chopped up, you would be fine because we broke out upwards. But you're going to be setting yourself back here. Not so much, right? You're going to get your account's probably going to blow up, and these are very unforgiving. And this is kind of a lot of people that traded this strength over here are no longer trading because of this over here. So it's incredibly important to listen to the feedback loop and identify kind of where we are. So this brings me to two things: position risk and account risk. Sorry, I'm trying to read the chat at the same time. Position risk and account risk. So position risk, your average risk needs to make sense for your average gain. Risk reward is way more important than win rate. People, when they first start trading, focus a whole lot on win rate, but it's really risk reward that makes a difference. So if you are selling stocks at 5%, and you are also risking 5% for them, that's a 1-to-1 risk reward ratio. And most traders do not have a win rate over 50%. So a 1-to-1 risk reward ratio, you're basically never going to go anywhere. And to use myself as an example, I know my average winner over the long term is well over 80%, and so I have no problem risking 8%. Now, this average winner being over 80%, this isn't because I'm amazing, right? This isn't because I'm super good. My time frame is a bit longer, right? I focus on weekly charts. If you guys are familiar with my character change, right? Like I'm looking to get into potential new uptrends, and so naturally when you zoom out and your time frame is longer, you're going to be a part of big moves. And so if you guys follow William O'Neill and Cam Slim, he talks about 8% max loss, and that 8% max loss is applicable and came from his studies because it's based on his trading and the way that he trades, and he's participating in these big long-term trends, and so to get involved in them, there's no issue with risking 8% if you could potentially get over 80%, right? That's an incredible risk reward ratio. Now, account risk is different. This is a total dollar amount you're going to risk per trade, regardless of stop. So it doesn't matter if my stop is 2% below my entry or 8% below my entry. The account risk is going to be always a different number. Like I said, if the market is choppy, if my recent trades are not getting traction, if my portfolio is not making any progress, I'm going to keep risk smaller until I see progress. On the flip side, if the market is doing well, my recent trades are all kind of working right away, and pushing past my buy point, and my portfolio is making progress, I'm going to step on the gas and I'm going to, um, you know, risk a lot more than I would in another market. So one of the number one questions that I have gotten is, how do I find stops on the weekly chart? And I think that people look at a weekly chart and they'll try to find a stop, and it's like it's so wide, right? Like how do you manage your risk on a weekly chart? And two things: most of my entries, they're during quiet periods, or they're on weakness. Not all of them I will buy strength. However, if I do buy strength, I am late for my system, but I will buy strength, and there are ways to get involved on that as well. But above all else, stops need to be logical, and they have to be based on structure. So what do I mean by logical and based on structure? There needs to be a logical thesis for where your stop is, right? You're not, if you see an entry and, I say that I'm fine risking 8% on a trade, it doesn't mean that you see an entry on a chart and then you just set a stop that's 8% away and that's your 8% stop. That doesn't make sense at all. That's a random stop, and your stop has to make logical sense, and it has to be based on structure. So if I take an entry and the stop is, or if I see an entry on a chart and the stop is 10% away, I'm not going to enter, right? Because I could make an 8% stop, but if it could easily pull back 8% and be completely fine, then I'm just setting myself up for failure, right? Because um, it's not based on structure, and so your stop needs to be logical, and it needs to be based, always on structure. Now, I wanted to dive into examples. So I have about 8 examples here of trades to show you guys very specifically. So this was Grab, a very recent trade that you guys, I told you guys when I was buying it. The general market is choppy. My portfolio has not been making progress, and my recent positions have not been getting traction. And so, if you guys scroll, the X subscription feed and or just search for Grab, you'll see my exact theory and why exactly I bought it. And so I bought it at this green line because it was a very quiet point within the wick, and then I set my stop about 5.8% away, basically because the theory buying this, right, is if this is strong, it's going to stay in the wick and break out. If it's not, it's gonna fall back. And so I basically gave it a little wiggle room in case it does come back. Uh, but my theory and the structure I'm looking for is really not to break below this previous candle here. And so the risk on this trade, position risk about 5.8%. And obviously, since the market has been incredibly choppy and my portfolio is not making progress, my total account risk, I'm allocating like 0.5% to this trade. So buying when I bought Grab, and if you guys look again, just go in my subscription feed and look at it, you'll see exactly what it looked like when I bought it and exactly why I did. And it was a quiet period, and so I was able to keep the risk way below 8%, and my account risk was small because the feedback hasn't been great, and I'm probably going to get stopped out of this trade. Now, last year, yeah, Will, good question. So how did I account for earnings, right? So by the time we had earnings, I I only hold through earnings if I have enough cushion. And so if you go to like optionslam.com, you can look up the expected move of a stock for earnings, and it's not always like 100% accurate. It could say a stock's expected to move 10%, and it could always move 5% or 30%. So you never know, but they give you a good direction of what to expect. And so I'll look up the expected move for Grab. I believe it was about 10%, and I basically before earnings will ask myself, okay, do I have a 10% cushion? Which I did. And in that case, I will hold through earnings, because if earnings gaps down 10%, I'm back to where I entered, and I'm giving up my profits, but I'm not, you know, I'm not digging into my account and taking a loss. Um, and so, it's still frustrating to get rid of profits, but uh, you know, optionslam.com, Ken, optionslam.com. You could just look up like implied moves for earnings, and there's probably other sites, but yeah, optionslam.com. So, that's how one, I kept the risk extremely low on a position level, and then again on the account level here. Now, last year was a different story. So SMCI, I want to explain, on the flip side. So for SMCI, I broke this down in a previous webinar, exactly the buys and the thought process and everything along. Like, I'm not gonna, share that in detail here right now, but essentially, I talk about a lot when a stock is basing, like a not just a random base, but like if a stock has a major run up and then bases, you want to pay attention to the base, because there's going to be clues where you can get involved earlier before a potential breakout. And focusing on weekly charts, right? That's super important, because again, a lot of risk is kept small when you're buying quietly end on weakness. And so we put in the low here, which I think earnings was here, earnings reported, and we kind of pushed off this low. And I was able to put on a couple buys on weakness for each of these higher lows, and built, a fairly large position with an overall risk of about 7%. But by the time, earnings was over here, I was profitable on the position and was able to hold. And so this never gave a sell signal, but I sold it right here, this red line. And the reason why I did that is because if you look, this was the beginning of 2024 last year. I had a big position in SMCI, and the very beginning of 2024, this broke out, and I made a ton of progress very early on in the year. And that is something that I wanted to lock in. And you could see, right, like it went from, I sold at 800 and it went all the way up to 1200. So I didn't nail the top, but I don't care about that. What's most important is this was like the first month or two in 2024. I was sized up big. I made a lot of progress, and I just wanted to take my profits. There was no sell signal. This wasn't, I didn't know anything here, but I just wanted to take my profits because I basically approach each year with a clean slate. My personal portfolio progress, like I'm always listening to the feedback loop, but I approach each year kind of with a clean slate. And so 2024, when you start off the year and have a big cushion in your portfolio, it really just gives you ease of mind to be able to, make better decisions going forward versus right now, right? I'm basically flat on the year. And so I've got to be very, very uh, strict with where like my rules and everything, and I don't really have room for error. But not only was last year a very strong year, but the fact that I was able to solidify really big profits early on in the year just set me up for a much better rest of the year because now I have cushion, and you have peace of mind versus just trying to start the year and get traction. DKNG DraftKings. So this was a trade I made last week and got stopped out pretty quickly. But again, the general market is choppy. My portfolio is not making progress. We had a major breakout over here through previous highs. So that's where this line comes from. It's a major, like a huge breakout, closed that high super strong. Um, but I couldn't buy it up here because the risk is just, way too large. And so when I saw last week that it was pulling back, it actually bounced off this level right here, which is a really positive sign of a retest. And so I did go ahead and I bought a position, which I was then stopped out of yesterday, Friday. Yeah, yesterday. So again, it doesn't really do too much damage to the account, right? The position risk was 4%. So this is how I keep risk tight on a position level. I know that, if we retest this right here, we should not break it and we should respect it and then, move back up. Retests are healthy if they do that. And so, I put my stop a little bit below that retest to give it a little wiggle room, because lines aren't, there's no such thing as a line in the sand. So wiggle room, I always, bake in. So here I gave it a little wiggle room. Unfortunately, I was stopped out, but again, it was a smaller position. And the position risk on this for 4%, the risk reward is really good because if this just retested successfully and the trade worked and it just went back to highs, that's already a 15% profit on the trade. So 4% for a very quick 15%. I would not obviously have sold here because if this was a real move, it would have, continued. But just to show you guys, like on a weekly chart, bigger moves are a lot more common. Now, this one I'm not in, but I just wanted to. I've been talking about this a lot in the X subscription, and so I just want to show you guys, how I would get involved. So let's say that next week, now that we're pulling back in, A concept that I explain a lot is changes in structure. So for over a year, this level has been resistance, and for the past couple months, it has been support, which is a huge change in character. So if I was to enter over here and give it, a little bit of wiggle room below this high, and basically below this candle that shook below here, risk is 6%. And so the logic here is multi-month resistance has acted as support, and if that changes, I do not want to hold. And I will show you why with Tesla. So fortunately, it all depends on where you enter. Structure kind of depends on where you enter and things like that. And so someone buying Tesla, if Tesla breaks out of this multi-year resistance here, and it did, but it failed to hold. But if it held here and broke out, this is a major move, that you want to be a part of. But you could see that Tesla failed to hold this level, and so that's the structure that we discussed, the logical structure that we discussed previously. And Tesla, once it lost that, you could see now it's pulling back. And if you were to buy this multi-month breakout here, and you ignore this structure and you're just holding through this right now, you're that's just not smart selling. And so the theory here is essentially the same thing, right? um the structure that we're identifying is resistance is now acting as support. And with Tesla, we kind of had the same thing, but it ultimately failed. And so that would be your sign if you were, buying Tesla to, get out. And then you can always buy back, right? Once it breaks out back above. Now to show you guys another example that's kind of in between these two, right? DE. I've been talking about DE a lot. Now, when DE first broke out above this multi-year resistance, I discussed, there's about a 5%, 6% risk where you buy this, and if it retests or continues up, you should be staying in. But if it doesn't hold this and it comes back into the base, you that's your structure breaking for your original theory, and so you do not, want to hold through that. Now, it doesn't mean that the trade is broken. It just means that you you still want to keep it on watch. You could see that if you bought this breakout here and then ended up holding, you would obviously be up on your position right now, right? Like it made a higher low and it's up. But in that scenario, if you bought this and held through here, that's a 13% loss. Even if you didn't lose, you're exposing yourself to a 13% pullback, and you never want to do that. That is never good. And so you always would want to take your loss right here, and then if you notice, this perking back up, you can get evolved again. You can always buy back, but you don't want to subject yourself to a 13% uh, loss. So yeah, this DE again, right? Like this is just a good example of, Tesla could very well do the same thing, right? Tesla could, make a low here and then break out to highs. But if you're buying the breakout of the multi-year base, especially in the type of market that we're in right now, you don't want to sit through this and hope it comes back up. You want to get out, take your stop, take your loss, keep an eye on it, and then, always be ready to buy back. I'm just checking the chat really quick to see position risk. Yep. Cool. Okay, I will we're almost done here with I think I have two more examples, and then I'll open it up to a couple questions. So this was last year, right? So I'm showing you guys a lot of examples of like this year. So this year, market's choppy. I'm, keeping my risk super tight, so that way, if I do get stopped out, I'm it's not setting me back. Now, if we go to last year, really good market. So I entered APP originally over here, right? It was a character change, and this was an incredible trade for me. Now, you could see that this this gray line here is the 10-week moving average, and this red line here is the 30-week moving average. Now, depending if I use the 10 or 30-week moving average for a sell, it always depends on, the context of the trade. So if I was to, let's say, enter here on this little consolidation breakout, I'm gonna notice that, okay, this stock has been respecting the 10-week the entire time, and so I'm going to want to use the 10-week to exit. So we broke the 10-week over here during the base, and so that's a smart exit. However, to give you guys context, like by the time that we broke the 10-week moving average, I was up over 200% on the position, and the market was also strong. So I decided, I'm going to use the 30-week moving average. And that is, you can't just, if you're not up 200%, or if you don't have a big cushion on a trade, like if I was up 5%, I'm changing my thesis in the middle of it, right? And I say that, oh, you know what? I'm gonna give it another chance and give it the 30-week. That's how you get set back, and that's how you really hurt yourself. But in a strong market and in a position that has made a lot of progress, you do have like leeway to do certain things that you would otherwise not if you did not have the position. So APP, most people are familiar with when this was basing here. I shared a very long tweet on why I think this is the best stock in the market, and it's because in this section right here, this basing period, I like when most people were seeing a stock that was basing and it was breaking, like a lot of people saw this stock consolidating. They kept seeing it break out, and then the breakouts were all getting failed. And so, it's a very frustrating stock. But for me, since I was involved very early and I was watching it very closely, I was very familiar with how this stock trades, and I was basically just very familiar with the personality of this stock. And so right here, I thought that this was the best opportunity in the market. And you could see that we never did break the 30-week moving average, at least in this screenshot. I screwed this trade up big time, which you guys know like later on. But up until this point, I did everything right. And so that's why, like when I bought here, if it would have broken the 10-week moving average over here, I definitely would have sold because my position was not up as much. But the fact that, I'm up 200%, it breaks the moving average, I'm going to kind of see like what it does. And you could see that, okay, we made our low in the base right here. And then, we never went lower than that. So each of these, just like SMCI, was a higher low within the base. And so, that's just very organized structure. So this is an example of, I entered here. I was kind of using the 10-week as a guide for exit until, the position became such a successful position that, and the market was strong, that I wanted to, let it base and let it kind of work. The last example that I have here, did I do SMCI? Yeah, I did. Okay. The last example that I have here is Peloton. So um, this Peloton trade I've explained on X as well, but I want to just dive into it a little here. So again, you're getting in during quiet periods. So I shared the post exactly when I bought this, and I was identifying the character change. And when you have, a character change, like you have this big volume pop, and then you move tightly, and essentially like this is a higher low. It's not, the same as we see pressure and we make a higher low on weakness, but this traded very tightly into the 10-week moving average. And so, it gave a very good opportunity to get involved, place the stop, below the weekly low, which is also the 10-week moving average. You have two kind of structural components there for the trade. And this trade, even though it's on the weekly chart, right, 6% risk. And, obviously at the highs it was well over 100%. And I explained on X2 how I sold this one pretty sloppily, sloppy. I sold this one pretty sloppy because I was just, coming into this year. The year became very choppy in the beginning, but we broke the 10-week moving average, and I noticed the market from the feedback just kind of started becoming very sloppy. And so, you know, when you're up this much with APP, I mentioned, maybe I'll switch to the 30-week moving average, but seeing how recent stuff wasn't working, I wanted to just, book gains and get rid of this. Unfortunately, I just messed up. I was a little sloppy and I sold, somewhere right here, if you guys could see my mouse. So I did give up, quite a bit than if I was a little more strict and just sold the crack of the 10-week. But again, you guys can see like this is a weekly chart. And again, my buy is 6% risk. So all of the examples that I have given you guys, you know, the trades are all within 8%. And you can see that they're all during, um, quiet periods. So that is basically what I wanted to share for this presentation. Now, selling, I know I've said that, it's a huge topic and it depends on a whole lot of things. But the most important takeaway from this that I want you guys to take away is this, right? I am in one of these two modes at all times, and I know what mode I'm in, not by looking at the market, right? Like I didn't look at that. Like the market was choppy when 2025 started, but this could have just been a pullback just like this over here. So it wasn't clear right away that okay, we're just going to go sideways for a bit. So I don't rely on looking at the general market to determine, exactly what type of market we're in. The very first thing that you guys are going to pick up is your feedback loop. So if you're making progress, if your recent trades are working, that's you're likely in a strong market. If you are not making progress, you're likely in one of these two markets, and you want to get defensive and you want to you need to adapt very quickly, and you need to listen to this feedback loop. And that is going to tell you what the type of market is in. And then once you know what type of market you're in, either to press on the gas or just be a little bit more defensive. So I hope that this helped answer some questions on exactly how I manage risk, right? Like, so I shared a lot of examples of how I'm setting my stops before I enter the trade and how I'm keeping that risk managed. And this is very applicable to the current market environment because a lot of these trades you could see are they're small pilot kind of positions because I'm just trying right now to get traction, and they're all based on structure. And so you can see this the theory behind this, the structure, it failed, I'm out. Could this next week, rip up and continue? Yeah, absolutely, right? And that happens all the time. There's never anything perfect, but the point is that your stops need to be based on structure first and foremost, and the risk, your total risk, needs to depend on if you are making progress. So with that, I will open it up to some questions. Sorry, guys, it's been an hour already. I did not realize I was taking so long. But yeah, I will take a couple of questions. And again, after this, I'll talk to you guys in the X subscription too. And I think selling is a huge topic. So there's going to be a lot more on selling as well. And I will definitely dive deeper into, specific things because selling is way more difficult and comprehensive than an entry tactic webinar or something like that. Is there a point at which I set stops to break even? Ken, yeah. So yes. So if we look at like, you know, SMCI, for example, or, just to answer your question better, you I do move my stops to break even or above break even to hold on to gains, but I do it longer. I'm not quick to do it just because I never want a big gain to turn into a loss, right? You don't want to round trip anything. So you don't want to be up 80% in a stock and then take a loss. Honestly, you don't even want to be up 80% in a stock and then sell for break even. So you never want to round trip, but I am usually a little slow to move that stop to break even just because, like, let me see, Upwork, right? So if I was to buy this on Monday and I set my stop, below here, if we start, if we keep chopping around to the side, I'm just gonna leave my stop here because the structure and the theory hasn't changed. I am going to give it a little wiggle room in case to kind of hold this support, but it hasn't changed. But if this starts to break out to the upside, then yeah, I'm going to adjust my stop. I'm going to start moving the stop up quite a bit. I'm very slow with moving my stops up, honestly, which is good and it's hurt me sometimes, but most of the time I am slow to move my stops up, and I have mental stops that are a lot tighter. And so what I do is I have a stop set so that if I'm not paying attention or if something terrible happens, I'm saved, right? Like I get stopped out and it doesn't decimate my account. And in those situations, I will definitely give back more than I would have wanted to, but I'm still fine. However, in most cases, I keep that stop a little wider and I have a much tighter mental stop in mind. That way, if I'm watching the market, I can let it kind of shake out. Uh, I can kind of make a decision at the end of the day instead of have it getting stopped out and having to buy back. So I'm usually, if that makes sense, giving a hard stop where just in case I'm fine and my risk is managed, and then I do have a mental stop where I execute. Usually, like I just market order it. How do you define upside target when you enter the reward part? So this is a great question. This is a great question. You never know what the upside. I don't ever try to guess the upside. Um, Let me see what example. Sorry, guys. So you never know the potential upside, but there's two things here. So, um, like I said, with DraftKings, if this would have retested and worked this entry, uh, I risked 4%. If this would have worked and just broke out to new highs, which is a very simple, like if the market is strong, breaking new highs here is kind of a no-brainer. It's not something difficult to do. Like it's what should be done, and so that's already 15%. So in this scenario, at a bare minimum, I'm risking 4% to make 15%. Uh, Now that's just kind of like a very short-term look. I ride trends and I don't guess targets. And so basically the way I determine, the upward part is just based on my recent trades. So like I said, all of my trades for the past few years, my average winner is well above 80%. And so knowing your average winner really helps you, you know, set your risk. I have no like I know my character change uh right here, this character change kind of pattern, and I know that, if I risk 8% on this all the time max, it's very simple. If this is a new uptrend, it's going to do more than 100%, hopefully. And so if you look at your recent trades and you see, your average winner is 80%, then that's what I use kind of going forward. Um, and too, like in a choppier market like now, you're not kind of getting that, but uh that's how I basically decide everything. I never have price targets, but it's always, on the weekly chart, larger gains are a lot more frequent, just because you're looking at bigger trends. And if I go back through my trade history, which you guys should all do, Rye does the exact same thing, right? If you look at your winning trades in the past, it will give you a very good indication of, what you can expect kind of in the future. And so that is what I do. I don't have price targets. When I buy something, I don't know if it's going to go up, you know, 20%, 100%, 200%. I'm always kind of just riding the trend, but I just know from looking at my history over time that 8% risk is what I'm very comfortable with because of, my average winning. Michelle says I was up 10% on Upwork and stopped out on Friday. So if we go to Upwork super quick, so this is why, your theory or your logic when entering the trade could have been different than mine, but this is the logical stop for me. Basically, like this trade can continue to chop around here, and be fine, and that's a sign of strength. But it's invalidated if it breaks back and gets into this zone right here. So yeah, like if I was to, let's say, buy here and then it went up like it did last week, I don't know exactly what that gain would be. It could be, 10% or so. But if it pulled back like it did, I'm still sitting in the trade. I'm, because there's no stop yet. There's no the structure is still intact. So, for me, um, you know, 10% could come back, and it all depends, logical structure. So as long as, if you got stopped out on what you planned when you originally entered, then that's fine. And as long as like the account risk was managed, now you just watch. And it's always better to be in than be out. But still Upwork, it stinks to get stopped out of this here, because if you look at the weekly chart, you know, the it's still the uptrend theory is still intact until we break this level. Yes, I am definitely more of a pullback trader than a breakout trader. Uh, Definitely. I always prefer buying breakouts. So, I mean, buying weakness. Just quickly to kind of cover why. Like a lot of a lot of people always want to buy a dip, but when the dip comes, they get nervous and they do not buy the dip. One of the benefits about weekly charts is when you do get the dip, since you're zoomed out on the weekly chart, the long term trend is very visible. Where if you're on a shorter trend and you get the pullback, sometimes you second guess things, and by the time you get to the level that you were waiting for, you're just now you're nervous and you think that the trend has changed, and so you feel a lot more comfortable buying breakouts. For me, kind of the way I look at it is the weekly chart, the trend is kind of always intact. And so if we're in a confirmed uptrend, then 75% of stocks, like we mentioned already, are going to go up in a confirmed uptrend. So if we get a pullback and I still see that the uptrend is intact, I kind of just view it as a rubber band. Like you're gonna kind of get the pullback, but the momentum is up, and so I've become very comfortable with buying pullbacks versus breakouts. Now, if I'm looking at a weekly chart and it's a stock that I should really be involved in and it's breaking out, I will still, get involved. If I look at snow as an example, so I think over here, sorry for so if we look at Snow, Snow originally, I bought my first position when we broke out above this area here. So we broke out on big volume, and we broke out of this consolidation here. And for like, I would have wished I bought it on weakness over here, but unfortunately I didn't. And I wanted to be involved in the position, so I will still buy a breakout. Uh, it's just you have to I'm not going to buy a breakout and then if I set my stops 15% below. It's just if the breakout's super, super strong and on really big volume, it really like should not come back. And so I kind of just will sneak myself in, by the strength, and that's really it. So I will buy breakouts, but like in this scenario, which I did get stopped out previously, but in this scenario, like if I'm buying a breakout, I'm late for my system. But I will, like, if a strong stock is breaking out on volume, a big leader, I'm not gonna miss it just because I prefer pullback. All right, I will take one more question. So on app, no higher high. What made you jump in? The assumption was a higher low. Just create. Oh, so yeah, let me pull up app really quick, or I'll just pull it up here. So app. So I assume most of you guys are familiar with the character change setup that I do, or that I watch. It's my favorite type of setup, and it has three characteristics. It has uh, a big volume pop off the lows, right, which we got right here in the beginning of 2023. But that's just one criteria. It doesn't mean you buy it, because if you look at like WB, so I showed on X that this is a potential character change, right? We have the big volume pop, and then we have now a higher low. So not only are you getting kind of the big volume push, someone's accumulating, but the higher low is basically saying that, okay, the trend has changed, and that is significant. And this is a very important part of the character change. Otherwise, if you just get the big volume pops, and this broke the downtrend here, this previous rip up, but it just went straight up and then made a brand new low. And so this is what we talked about previously in bear markets, or in downtrends. You get these really violent rip up, and just because you get this doesn't mean it's a character change. We want to see the higher low. And so when you see the higher low, which we did get afterwards on APP here, um, it tells you that, okay, big volume pop, someone's interested in this, right? uh High or low, okay, the trend has likely changed, and we're kind of riding the 10-week moving average here. So this is the entry that I'm trying to get on every position, even Peloton. It's kind of not the same because Peloton drifted sideways instead of a higher low, but still, right? Like, all these previous pops up on Peloton kind of just get followed to new lows, and when you finally get that sideways action or the pullback to a higher low, it just confirms that, okay, this is more than just an oversold bounce. The trend has changed. Buyers are in control, and the odds are way more in your favor. Awesome. Okay. No, the last question right here. Sorry, guys. There's a lot of questions. I will answer them later though in the X subscription. But no, I'm not in snow. I actually sold snow Friday, and you know, for this is not a nice candle right here, but still, like, it's well above my entry where I bought over here, and it still hasn't even come down to the 10-week. So technically, in a strong market, I would have never sold this. But just because, this market's been choppier and it's been harder to make progress, I just, I just blew this out. And um, yeah, that's really it. I just blew this position out, and I kind of just wanted to start with a clean slate. So this technically, no, it's not a sell signal, but we're in a tougher environment right now, and I kind of just wanted to blow it out. All right, last question, Roger. Yeah, so how many pilots? It depends, right? Like this year, I've put out quite a bit of pilot trades. And if you keep doing too many, you're still gonna chop yourself up, even though the risk is managed. But um, I don't know how many I put on exactly, but I have put on quite a bit of positions, and they've all kind of failed, which is why I have stepped back quite a bit. But um, when the market moves from chop or weakness to strength, you build on top. Yeah. So if I put on a pilot position and the market starts really strengthening and that position starts working. So just to explain this, if we go back to APP, let's just say the market was weak here and I put on a pilot position and then the whole market starts strengthening and my portfolio is making progress, my recent trades are working, then yeah, I'm going to look to add to it and get involved. So that could be. I don't exactly remember where all the earnings are on here, but there's tons of there's tons of opportunities. You could see that each one of these kind of wicks down to the 10 week, and we never broke below this 10 week. So if you're really paying attention, and if this was a pilot position, yeah, I would add a little more here. But there's no rush, right? There's no rush ever. Even if I have a pilot position here and then I put on the rest of the position over here, I mean, APP now is trading at what, 400 or something. So, uh, there's no rush. If you genuinely have a strong market and you get a stock early in its trend, a lot of people kind of rush to add to their position, but there's really no rush. You want to wait for the right times, and every add to your position, you should ask yourself, if I wasn't already in this stock, would I buy it here for the first time? And if the answer is yes, then it's a good ad. If the answer is no, then it's a bad ad. So that's how I determine my ads. If I would not enter my ad on for the to open the position, I it's a bad ad and I'm not going to do it. I'm rushing. If I would open it for the first time, then it makes a good ad to the position, and yeah, that's basically it. Cool. Guys, I hope you found some value in this. Again, I know there's a lot of questions around selling. I doubt I answered them all. I will talk to you guys on X and, you know, get your feedback and questions that you still have, and we will set up another webinar uh, for, a day next week or next weekend, whatever's kind of the best time for everybody. But I hope that this was helpful. This was highly requested. I hope I did not disappoint and you learned something. But yeah, please let me know anything that is confusing still on X, or anything you'd like clarification on, and I'm more than happy to help you guys. So thank you very much for joining. I appreciate you spending your Saturday with me and Rye, even though Rod didn't get a chance to talk just because I took so long. Sorry about that, guys. Awesome. Have a good weekend, and I will talk to you guys all on X. And this recording will be up tomorrow. Have a good one, guys.